Good morning. Wall Street leaders warn of rising risks in private credit right now. And over the past decade, private credit has quietly become one of the fastest growing segments of global finance. And what began as a niche alternative lending market has expanded into a massive $1.7 trillion industry, which fuels real estate projects, corporate expansions, and leverage buyouts. But recently, some of Wall Street's most experienced leaders have begun issuing warnings. So some executives, including Jamie Dimon from JP Morgan Chase and Lloyd Blankfein, former Goldman Sachs CEO, as well as Bruce Richards, Marathon Asset Management, are signaling that the rapid expansion of private credit may be masking deeper risk beneath the surface. And for real estate investors, developers, and borrowers navigating the financing landscape, understanding these risks matter because private credit increasingly plays a role in real estate and mortgage financing. So let's talk about the rise of private credit. And private credit refers to loans issued by private lenders rather than traditional banks or public debt markets. And these lenders can often include, say, private debt funds, often backed by hedge funds or insurance companies, but they could be from asset managers or alternative investment platforms. And private credit gained traction after the 2008 financial crisis when stricter banking regulations reduced traditional lenders' appetite for risks, and they stepped in to fill a void. And since then, the private lenders have stepped in to fill that gap. And what they do is they provide financing for, say, commercial real estate projects, or corporate acquisitions, or for middle market companies, but also a lot of bridge loans and mezzanine financing. And today, the market has ballooned to approximately 1.7 trillion, making it one of the largest alternative investment sectors globally. So why Wall Street is raising concerns? While the growth of private credit has created new opportunities for borrowers and investors, industry veterans are beginning to question whether the market has expanded too quickly. So several structural concerns are emerging is the point. And first is the lack of transparency. One of the biggest challenges in private credit is valuation transparency. And unlike publicly traded bonds or loans that trade daily, many private credit investments are really illiquid and rarely traded. That means valuations are often based on the internal models of the person marketing them or manager estimates, or they're really just limited comparable transactions. So we don't have a good benchmark. And as a result, investors may not know the true market value of a loan until it is sold or refinanced. And in volatile markets, this can create pricing gaps and delayed recognition of losses. Two is late cycle lending behavior. Now, financial markets tend to move in cycles, and extended periods of strong performance can sometimes encourage looser underwriting standards. We certainly saw that in 2008. And according to Lloyd Blankfein, long stretches of economic stability can lead investors to, say, underestimate their downside risk and increase their internal leverage, but also to finance more speculative deals. And historically, these patterns often become visible near the later stages of credit cycles. Three is sector concentration risk. Another concern raised by Marathon Asset Management's founder, Bruce Richards, involves heavy exposure to technology companies within private credit portfolios. Think Blue Owl, they just had a bunch of notes that just traded. During the low interest rate era, many technology firms raised capital aggressively through private lenders. But if economic conditions tighten and defaults within certain sectors could increase, we have a problem. Richards has suggested that default rates in tech-related private credit investments could potentially reach 15%. Four is liquidity challenges. So unlike public markets, private credit assets often require a specialized buyer with the ability to perform deep credit analysis. So that means when investors want to exit their positions, they could encounter, say, a limited buyer pool. It could result in longer transaction timelines, but also potential valuation discounts to make the deal work. And this illiquidity can amplify losses during periods of economic stress. So, why this matters for real estate and mortgage markets. And private credit is not just funding corporate deals, but it is also a growing source of capital for real estate financing. And in commercial real estate, private lenders frequently provide bridge loans, construction financing, mezzanine capital, but also preferred equity structures. And for borrowers, private credit can be attractive because it often offers faster approvals, more flexible underwriting, and creative deal structuring. However, the trade off is typically the higher interest rates and more complex loan structures that come as part of it. And if private credit markets tighten, it could impact real estate liquidity and refinancing options. So let's talk about why structure matters more than ever. And for borrowers and investors navigating today's environment, the key takeaway is simple. Not all capital is created equal. And understanding the structure behind financing, including potential loan covenants, leverage levels, and exit strategies, is critical. Now, whether you're working with traditional banks or alternative lenders, experienced advisors can help structure financing that balances opportunity with risk. And as the credit cycle evolves, discipline and thoughtful underwriting will continue to separate strong deals from vulnerable ones. So I have some final thoughts for today. And private credit has become a powerful force in global finance, offering new financing pathways for businesses and real estate investors. But as the sector expands rapidly, experienced market leaders are reminding investors to remain cautious. So, what we're seeing is a combination of rapid growth and limited price transparency, but also sector concentration and the dangers that come around after late cycle underwriting concerns. And all of this could create vulnerabilities if economic conditions shift. So, for borrowers and investors alike, understanding these dynamics can make the difference between smart leverage and potential hidden risks. That, my friend, is it for the day. Please visit my website, billraponline.com. You can figure out how to get a hold of me. I'd love to talk to you more, but we do mortgage and capital advisory for commercial projects. Thanks for your time. Have a good day.